Welcome to Money Making Minds YouTube channel, and thank you for joining us for a deep dive into the one number that fundamentally changes how you approach every single trade you take.
It's great to be here.
Our mission today, well, it's pretty straightforward. We're diving straight into the work of Ryan Bolt. We're going to extract the most vital insights from his analysis on something called the risk-to-reward ratio, RRR for short.
Yep. RRR, it's fundamental.
We want to give you a real shortcut, basically, to treating trading like a profitable business, not like a trip to the casino.
Exactly. And this isn't about, finding some magic stock pick. It's way more fundamental.
It's about the mechanics.
It's about controlling your losses, structuring your potential gains. Ryan Bolt makes this incredibly powerful case that your actual profitability, it has almost nothing to do with how often you're right.
That sounds completely counterintuitive.
It does, doesn't it?
Yeah.
But it's everything to do with how you manage this one single ratio. Seriously, if you only internalize one lesson about trading, this should probably be it.
Okay, let's unpack this right away then. And Bolt kicks things off with a story, right? A lesson he learned the hard way.
Oh, yeah. He talks about his own foundational mistake, what he calls the worst trade he ever made. It was back in 2018, involved Tesla.
Tesla, okay. It always seems to be Tesla.
Right. And this wasn't some tiny slip-up. It was a complete fundamental misunderstanding of risk management.
So what happened? What was the setup?
Well, the setup was pretty typical, actually. Lots of bullish excitement around Tesla. It was trading around $380.
Right.
And Bolt was convinced, absolutely convinced, it was heading for a quick pop to $400. That was his target, a psychological level.
So aiming for $20 a share profit sounds okay on the surface.
It does, but here's the kicker. He was so fixated on that potential $20 gain, he completely failed to define his risk up front. He didn't set a stop loss initially.
That's the classic mistake, isn't it? No exit plan if things go south.
Exactly. And Bolt calls that the cardinal sin in hindsight because he didn't have that stop. He just held on. He used hope as his strategy.
That boy.
He watched Tesla drop. $350, then $340, convinced, it had to bounce back. It just had to.
But it didn't.
It didn't. And the fear of actually taking that loss, of crystallizing it, just kept him frozen, paralyzed. He finally gave up, capitulated, sold his shares way down at $320.
Wow. So from aiming for $400, he gets out at $320.
Yeah.
That's a big hit.
It was devastating. He lost $60 per share. Remember, he was only chasing a $20 gain.
So wait, let's do the math backwards on that. He was risking $60.
To potentially make $20. Yes. That's a completely backward 3-to-1 risk-to-reward ratio. 3 units of risk for just 1 potential unit of reward.
But painful.
He paid 3 times the price for the chance to make 1 unit of profit, and the outcome losing way more than he ever hoped to gain. That's precisely why the mathematics of RRR matter infinitely more than your ability to predict the market.
Okay, so that story really sets the stage for this whole, counterintuitive idea about profitability.
Absolutely.
Because most people, especially starting out, they think, if I could just be right 60%, maybe 70% of the time, I'll make money.
Right, that's the common assumption. But Bolt shows very clearly that a high win rate means absolutely nothing if your RRR is fundamentally broken.
It's like winning battles but losing the war.
Precisely. Let's look at 2 scenarios Bolt lays out. 10 trades each. Really highlights this paradox.
Okay, scenario 1. This is the trader with the amazing win rate. Let's say out of 10 trades, you nail 7 of them. You're right 70% of the time. Feels great, right?
Feels fantastic. But just like Bolt's Tesla trade, let's say you structure your trades poorly. Your average winner only makes you $100.
Okay.
But your average loser, that costs you $300. Maybe you let losers run too long, hoping they'll come back.
Right. So let's run those numbers. 7 wins times $100. That's $700 in gains.
Correct. But then you have 3 losing trades, and each costs you $300. So that's a total loss of $900.
So $700 gain minus $900 loss. You're actually down $200.
Exactly. You spent all that effort. You were right most of the time. 70% correct predictions. And you still lost money. That's what Bolt means by a broken system. It guarantees failure no matter how good you are at predicting.
Okay, that's sobering. Now, scenario 2. This is where it gets interesting, right? The supposedly bad trader.
Yeah, this person is only right 40% of the time, so 4 winners out of 10 trades. That means they're wrong on 6 trades. They lose more often than they win.
Doesn't sound like a recipe for success.
You wouldn't think so. But here's the crucial difference. Their RRR is structured properly. They follow the rule. Their average winner makes them, say, $300.
Okay.
And their average loser costs them only $100. They cut their losses quickly.
So they're risking 1 unit to make 3, a 1-to-3 ratio.
Exactly. Now let's look at the math. 4 winners times $300 each. That's $1,200 in gains.
Nice.
6 losers times $100 each. That's $600 in losses.
So $1,200 gain minus $600 loss. That's a positive $600 net result.
Bingo. You were wrong more often than you were right, yet you ended up profitable. Significantly profitable, actually, compared to the first trader who lost money.
That comparison really nails Bolt's core message, doesn't it? You can be wrong more often, even most of the time, and still build wealth if your risk to reward is structured correctly. Ideally, he says, aiming for 1 to 3 or even better.
It completely changes the game. It frees you from this immense pressure to perfectly predict the market, which, let's be honest, impossible anyway.
The market does what it wants.
It does. Your job isn't to predict the exact top or bottom. Your job is to find setups where the potential reward justifies the defined risk, ideally by at least 2 or 3 times. #tag2. Understanding RR from the ground up.
Okay, let's get really tactical now. Let's define this RR number crystal clear for everyone listening.
Good idea. So RRR, the risk to reward ratio. It's simply a comparison. It compares the potential loss you've defined, that's the risk, against the potential gain you've defined, the reward, before you even click the buy or sell button.
It's a plan, not a reaction.
Exactly. It's a ratio. So if you're risking, say, $500 on a trade with the potential to make $1,500.
That's a 1 to 3 ratio.
Perfect. 1 unit of defined risk for 3 units of potential reward. Let's use a concrete stock example Bolt gives. Apple.
Okay, Apple. Let's say we're thinking of buying it at $180 per share.
Right. So the first step, the professional step, is defining your risk. You look at the chart, maybe there's some support nearby, and you decide your stop loss. The price where you absolutely get out if it goes against you is $175.
Okay, so the difference, $180 entry minus $175 stop, is $5 per share. That's our risk.
That's your risk per share, defined. Next, you define the reward. Where do you plan to take profit? Let's say based on resistance or a price target, you set your target at $195.
Right, so the reward is the target minus the entry. $195 minus $180, that's $15 per share.
Exactly. So now you have both sides. You risked $5 per share to potentially make $15 per share.
Which gives us a raw ratio of 5 to 15.
Which simplifies down cleanly to 1 to 3. That's your RRR for this trade. And those numbers, the $5 risk and the $15 potential reward, they form the sort of contract for that trade. You define them before you enter. If you don't do that,
you're just gambling, flying blind.
Pretty much. And notice, we always say 1 to 3, not 3 to 1. Risk comes first.
Right, I noticed that. Why is that convention so important? Why always list risk first?
It's a discipline thing, really, and it's non-negotiable among pros. The rationale is psychological.
Okay.
Professional traders think of themselves as risk managers first, then profit seekers second. Your primary job is capital preservation.
Protect the downside.
Always.
Yeah.
So when you analyze a potential trade, the very first question has to be, how much could I lose here? By listing the risk first, in the ratio, like 1 to 3, you reinforce that risk-centric mindset. It keeps the potential loss front and center before you get dazzled by the potential profit.
That makes sense. It frames the decision differently.
Totally. If someone says they took a 1 to 4 trade, you immediately know they kept their risk tight relative to the reward. If they say they took a 4 to 1 trade, you instantly know they risked $4 to make one. That's a red flag. It acts as an immediate mental filter for trade quality.
Okay, speaking of filters, Bolt is pretty strict about the minimum acceptable ratio, isn't he? Calls it a line in the sand.
Oh, absolutely dogmatic about it. And for good reason, it's about survival. The rule is clear. Never, ever, ever take a trade with less than a 1 to 2 risk to reward ratio.
1 to 2 is the absolute floor.
That's the minimum acceptable for building a sustainable trading business. Anything less than that, say 1 to 1.5 or 1 to 1, ensures that even a normal string of losses will just grind down your account over time.
Why 1 to 2 specifically, though?
Yeah.
What's the math behind that being the minimum, the break-even point?
Right. Let's look at the break-even math. At a 1 to 2 RRR, you only need to be right roughly 34% of the time just to break even. Think about it.
Okay.
If you take, say, 100 trades, if you lose $1 on 66 of those trades, that's a $66 loss.
Right.
You only need the remaining 34 trades to be winners, making $2 each, since it's 1 to 2, to make $68. That covers your losses. So you can literally be wrong on almost 2 out of every 3 trades.
And still basically tread water.
Exactly. You survive. That huge margin for error gives you incredible psychological breathing room. You don't have to be perfect.
And that really contrasts with the mistake a lot of beginners make, right? Taking trades that are basically one-to-one, risking $100 to make $100.
Absolutely. That one-to-one trade looks balanced on paper, doesn't it?
Yeah.
50% win rate needed to break even seems achievable.
Yeah, it sounds like a coin flip.
But that 50% break even is a fantasy once you factor in the real-world costs of trading. Bolt highlights 3 hidden killers here.
Okay, what are they?
First, commissions or brokerage fees. Every trade costs something. Second, slippage.
Ah, slippage. Explain that quickly.
Slippage is when the price moves against you between the moment you hit sell on your stop loss and when the order actually executes, especially in fast markets. If your stop is at $100, you might get filled at $99.80. That extra 20 cents loss per share is slippage. It adds up.
Got it. So commissions and slippage eat into your profits and widen your losses.
Right.
What's the third killer?
Opportunity cost. While your capital is tied up in that mediocre one-to-one trade that might just chop around break even, you could be missing out on a much better 1-to-3 setup somewhere else.
Right. So all those factors combined mean a one-to-one trade is actually designed to lose you money over the long run.
Mathematically, yes, it's a losing proposition, which is why that 1-to-2 minimum is so crucial.
Okay, this is where Bolt really drives the point home with that compounding example, comparing 3 traders.
Yeah, it's powerful. He takes a hypothetical $10,000 account, 3 traders, all taking 100 trades. They all risk exactly 2% of their account per trade.
Okay, consistent risk management there.
And crucially, they all have the exact same win rate, a very realistic 40%. They are only right on 4 out of 10 trades.
Right, so performance-wise, skill-wise, they're identical. The only difference is their RRR.
Precisely. Trader A uses that dangerous one-to-one RRR. They risk $200, 2% of $10, to make $200.
Okay.
Their 40 winning trades net $200 each, so that's $8,000 in gains. But their 60 losing trades cost $200 each, totaling $12,000 in losses.
Ouch. $8,000 gain, $12,000 loss. Net result is negative $4,000.
Yep. Down 40% on the account, despite being right 40% of the time.
Wow. Okay, Trader B, this one uses the minimum acceptable, the 1-to-2 RR, risks $200 to make $400.
Correct. So 40 wins times 400 is $16,000 in gains. The 60 losses still cost $200 each, so $12,000 in losses.
$16,000 gain minus $12,000 loss. Net result is positive $4,000.
Now we're talking up 40% on the account, same win rate, totally different outcome.
Okay, and now the punchline, Trader C. This one aims for the professional standard, a 1-to-3 RR. Risk $200 to make $600.
All right. 40 wins times $600, that's $24,000 in gains. The 60 losses still cost $12,000.
$24,000 gain minus $12,000 loss. Net result is a positive $12,000.
A massive positive $12,000. They are up 120% on their account.
That's incredible. Same account size, same risk per trade, same win rate. But the 1-to-3 trader ends up massively profitable. The 1-to-2 trader makes a good money, and the 1-to-1 trader loses significantly.
That's the power of the structure Bolt talks about. It's not theory. It's the literal structure of the payoff that dictates your long-term success. You stop trading stocks, you start trading a mathematical system.
Okay, so we understand why we need these good ratios, like 1-to-3 or better. But the next question is, how do you actually find these setups in the real market? It's messy out there.
It absolutely is. And knowing you need the ratio is one thing. Finding trades that objectively offer it is the practical challenge. Bolt identifies the foundation here as understanding and using support and resistance levels.
Right, the classic technical analysis concepts where buying or selling pressure tends to show up.
Exactly. These levels where price has historically stalled or reversed are crucial because they give you logical, objective places to put your stop loss and your profit target. They provide the market's inherent structure.
Makes sense. You're using the market's own behavior to define your risk and reward.
Precisely. Let's use the Salesforce CRM example Bolt gives to show how sometimes even a logical setup doesn't quite cut it ratio-wise. Let's say you're looking to buy CRM around $210. You look at the chart and see clear support down near $200 and maybe some resistance up around $235.
That seems reasonable.
So to structure the trade logically, where would you put your stop? Probably just below that support level, right? Maybe $198, give it a little breathing room.
Okay, $198 stop from a $210 entry. That's a $12 risk per share.
Correct. And your target. You'd aim just below that resistance, perhaps $232, to increase the odds of getting filled.
So $232 target from $210 entry. That's a $22 potential reward.
Right. Now calculate the RRR. $12 risk for a $22 reward. That simplifies to roughly 1 to 1.83.
So it's positive, but it's less than the 1 to 2 minimum we just talked about.
Exactly. And this illustrates a key point Bolt makes. Even a technically sound, logical trade setup might not meet the minimum RRR requirement. And his advice is strict. You have to be selective. You have to be willing to walk away from perfectly decent-looking trades if the math isn't there. You wait for the higher quality, higher RRR opportunity.
Patience and discipline. Don't chase mediocre setups.
That's the core of it. But thankfully, there are specific types of setups that inherently tend to offer better ratios. Bolt highlights two favorites, the breakout and the pullback.
Okay, let's talk breakouts first. These sound exciting.
They can be. The breakout setup works because when a stock pushes decisively above a well-defined resistance level, it often triggers a fast, strong move. Old sellers are cleared out, new buyers jump in. Let's use his Netflix NFLX example from 2023.
Okay, Netflix. What was the setup?
Netflix had been stuck, consolidating in a tight range between $420 and $440 for weeks. That $440 level was a clear ceiling. Price hit it multiple times and failed.
Like a lid on the pot.
Exactly. So the trade is designed to capitalize on the moment price breaks above that $440 lid, anticipating a move higher.
How do you structure the risk and reward then?
It's specific. The entry is just above the breakout level, say $442, to confirm the break is real. You don't try to guess the exact bottom of the break.
Right. Wait for confirmation. Where's the stop?
The stop goes back below the breakout level, maybe $435. If it falls back into that old range, the breakout thesis is invalid.
Okay, $442 entry, $435 stop. That's a $7 risk per share.
Tight.
Very tight. And the target. One common way is to measure the height of the consolidation range, in this case, $444 to $420, and project that upwards from the breakout point, $442. So $442 plus $20 gives a target around $462. Let's say $470 to be safe.
Okay, let's recheck that math. $7 risk for a potential gain of $470 target minus $442 entry is $28 reward.
Exactly. $7 risk for $28 reward. That is a beautiful 1 to 4 risk to reward ratio.
Wow, yeah, that's the kind of setup you wait for.
Precisely. And Bolt stresses patience here. Wait for that confirmation candle, close above resistance. It might mean you get in slightly higher, but it drastically improves the probability of the trade working, and the RR is still fantastic. A confirmed high RRR trade beats a speculative low RR guess every time.
Okay, so that's the breakout. What about the pullback setup? Pullbacks are great because they often let you get in at a better price within an already established uptrend and usually with a tighter stop loss. This naturally leads to great RRR.
So you're buying the dip in an uptrend.
Essentially, yes, but not just any dip. You're buying when the stock pulls back to a logical, established support level. Let's use the Adobe ADBE example from early 2024.
Adobe, okay, strong uptrend.
Very clear, strong uptrend, and it temporarily pulled back to around 532 TORs. Now, crucially, that 532 TOR price coincided almost perfectly with its 20-day moving average, which had been acting as dynamic support.
Ah, so multiple reasons for support at that level.
Exactly, that gives you confidence. So the structure. Entry right there at $532, buying off that support. Stop loss goes just below that support level, and the moving average, say, $522.
Okay, $532 entry, $522 stop. That's a very tight $10 risk per share.
Super tight. And the target, you might project the size of the previous up leg in the trend, aiming for something like $575.
Let's see, $10 risk. And the reward is $570 target minus $532 entry. That's $43 reward.
$10 risk for $43 potential reward. That works out to an incredible 1 to 4.3 ratio.
Again, fantastic.
Yeah.
And the key there was buying at that known support level, allowing for the really tight stop.
That's the advantage of the pullback. You get surgical stop placement because you have a clear line in the sand provided by the trend and support.
Now, you mentioned moving averages acting as support. Let's touch on some of these maybe more advanced ways to find these levels.
Right. Support and resistance aren't just static horizontal lines. Moving averages, especially the 20-day simple moving average, SMA, often act as dynamic support in uptrends or resistance in downtrends.
Like with the Adobe example.
Exactly. If you see a stock like, say, Microsoft in late 2023, consistently bouncing off its 20-day MA as it climbs, that MA becomes a reliable entry zone on pullbacks. Buying right at the MA lets you place a tight stop, maybe just 1.5% or 2% below it, which can often set up 1 to 3 RR trades without needing huge price moves.
Okay, and we definitely need to talk about Fibonacci retracements. People seem to love or hate them.
They do. Bolt kind of lands in the camp of, look, maybe they work just because so many traders watch and use them, which makes them a self-fulfilling prophecy.
A psychological phenomenon.
Could be. But regardless of why they work, the fact is they do provide objective support and resistance levels that many global traders use.
So how do they help find RRR setups?
When a stock makes a big move up and then starts to pull back, traders use the Fibonacci tool to draw retracement levels between the low and high of that move. The key levels are usually 38.2%, 50%, and 61.8%.
Okay.
The idea is that the pullback will often find support at one of these levels before resuming the uptrend. So using an NVDA example Bolt provides, if NVDA pulls back and bounces strongly off the critical 50% retracement level, that's your potential buy signal.
Where did the stop and target go?
You'd typically place your stop just below the next Fibonacci level down, maybe the 61.8% level, giving it some room. Your target would often be the previous high of the move, or even higher if the trend is strong.
And the RR?
In the NVIDIA example structure Bolt described, buying at the 50% fib level might involve a, say, $17 risk, stop below the 61.8% for a potential $58 reward, targeting the prior high. That gives you a solid 1 to 3.4 ratio structure.
So using these widely recognized technical levels provides objective points to define that risk and reward.
Exactly. It takes the guesswork out. Technical analysis gives you the potential structure, but RRR is the filter you must apply. If the structure doesn't offer at least 1 to 2, you just wait.
Okay, so we've established why the ratio is key and how to find setups with good ratios. But even a perfect 1 to 4 setup can blow you up if you bet the farm on it, right?
Oh, absolutely. This brings us to what Bolt calls the absolute backbone of risk management. Position sizing. It's just as crucial as RRR, maybe even more so in some ways.
And he shares another painful anecdote here involving Shopify.
Yeah, a brutal one from 2019. He found this beautiful setup on Shopify. Technically perfect, looked like a 1 to 3.5 RRR. He felt incredibly confident, too confident.
Oh.
He ended up risking 25% a quarter of his entire trading account on that single position.
Wow. That's way too much.
Way too much. The market turned against him. He got stopped out. Now, the actual dollar loss was only $400, which maybe doesn't sound account-ending in itself.
Right.
But the emotional shock, the psychological hit of seeing 25% of his capital potentially vanish on one trade was so severe it completely paralyzed him.
He couldn't trade afterwards.
He spent 2 weeks just stewing, frozen by fear and regret. And guess what happened to Shopify during those 2 weeks?
It rallied without him.
Massively. It started the exact rally he had anticipated. By risking way too much, he protected his dollar capital in the short term by taking the $400 loss, sure, but he destroyed his mental capital. And that mental damage cost him a potential 5-figure gain.
That's a powerful lesson. If a loss feels that devastating, your position size was just too big, period. Doesn't matter what the RRR was.
Exactly. And that experience led Bolt to formulate the rule he calls non-negotiable, the one that basically saved his trading career, the 1 to 2% rule.
Okay, the 1-2% rule. Let's break that down.
It's simple, but absolute. Never risk more than 1% to 2% of your total account equity on any single trade. And the critical point here is that's the maximum amount of money you can lose if your stop loss gets hit, not the total amount of money you put into the trade.
Okay, that distinction is vital. It's about the risk amount, not the position value. Let's do a clear calculation example. Say you have a $50,000 trading account, and you decide to stick to the more conservative end, the 1% risk rule.
Okay, 1% of $50,000 is $500. That $500 is your maximum allowed loss for this specific trade. That's your risk budget.
Right. Now, let's say we're looking at Amazon, AMZN. We decide to buy at $145. Based on support levels, we set our stop loss at $140.
Okay, so the risk per share is $145 entry minus $140 stop, which is $5 per share.
So how many shares can we buy?
The calculation is straightforward. You take your total risk allowed, $500, and divide it by the risk per share, $5.
$100 divided by $5, that equals 100 shares.
Exactly. You are allowed to buy exactly 100 shares of Amazon for this trade, no more. Now, that position might cost $14,500 to put on, 100 shares, $145, which is nearly 30% of your account value.
Right, that sounds like a big position.
It sounds big in terms of capital deployed, but if the trade goes wrong and hits your $140 stop, what's your actual loss?
It's 100 shares times the $5 loss per share, which is $500.
Exactly $500, which is precisely 1% of your $50,000 account. The size of the capital deployed is almost irrelevant. It's the capital at risk that matters, and that must be capped at 1-2%.
That makes so much sense. It decouples the trade size from the actual risk taken.
And understanding this is critical for long-term survival. Bolt calls it the math of survival. Why 1-2% and not, say, 5% or 10%? Because compounding losses are absolutely brutal.
Right, losing streaks happen to everyone.
Everyone, even the best traders. Let's look at the impact of 10 consecutive losses. A bad run, but possible.
Okay, what happens if you risk 10% per trade?
If you risk 10%, after the first loss, you're down 10%. The second loss is 10% of your new, smaller capital base. After 10 losses in a row, you're not down 100%. You're actually down a staggering 65.1% of your starting capital.
Wow, nearly two-thirds gone.
Gone. And to get back to just break even from being down 65.1% requires a gain of over 230% on your remaining capital. It's mathematically crippling. Most accounts never recover from that.
Okay, but what about sticking to the 2% rule? 10 losses in a row at 2% risk.
If you rigorously stick to 2% risk per trade, those same 10 consecutive losses will put your account down approximately 18.3%.
Still hurts, but...
It still hurts, absolutely. You're down, you need to take a break, reassess, but you are still completely in the game. Your capital is largely intact, you can recover relatively easily. That mathematical difference is what separates traders who survive drawdowns from those who blow up and quit forever.
The 1-2% rule is your financial Kevlar vest, basically.
It really is. And it also acts as a crucial defense against our own psychology, specifically that powerful bias Bolt mentions, loss aversion.
Right. The research showing losses hurt about twice as much psychologically as gains feel good.
Exactly. Our brains are wired to avoid pain. If your potential loss on a trade, because your position size is too big, represents a painful amount of money to you, that pain will cloud your judgment. You'll hesitate to take the stop loss. You'll hope it comes back.
You'll break your own rules because the pain is too great.
Precisely. But the RRR system, combined with strict 1-2% position sizing, works with this psychology.
How so?
By forcing yourself to aim for, say, 1-3 RRR and ensuring each loss is only a tiny, manageable 1-2% of your capital, you make the losses psychologically insignificant. They sting a little, sure, but they don't cause deep pain. And then when the inevitable 1-3 winner comes along, the gain is large enough 3 times the size of those small losses to feel good and easily overcome the mild sting of the losers. You're using positive asymmetry to your psychological advantage.
You're making the wins feel bigger than the losses, even if the losses happen more often.
Exactly. And finally, on position sizing, Bolt issues a necessary stern warning about something that completely destroys all this careful calculation.
What's that?
The cardinal sin of trading, averaging down.
Adding more money to a losing trade, hoping to lower your average entry price.
It sounds smart to some, but Bolt calls it hope disguised as strategy. When you impulsively add to a losing position, you completely throw your 1-2% risk calculation out the window.
Because your original stop loss was based on the first position size.
Right. If you bought 100 shares of Amazon with a $5 stop, risking $500, and then it drops and you buy another 100 shares at a lower price, but keep the same $140 stop loss, you've just doubled your position size and if would doubled your risk to $1,000 or 2% of your account without any new technical reason. You're just doubling down on being wrong.
Violating the risk plan.
Completely. A small, calculated 1-2% loss that hits your stop is always infinitely better than letting a loser grow and then compounding the mistake by averaging down.
Okay, so position sizing is the backbone, setting the amount of risk. Now let's talk about the execution of that risk plan. The stop loss itself. It's like the insurance policy, right?
It is exactly that. It's your mandatory insurance. Bolt is emphatic. If you don't consistently honor your predefined stop losses, you are simply not trading according to the business model he outlines. You've stepped outside the system and become a pure gambler again.
And he uses that really stark Boeing example from 2020.
Yeah, a trader he knew had a plan for Boeing. The technical setup gave a clear stop-loss level, about $15 below entry. But when the stock started to fall hard during the initial COVID panic,
They didn't take the stop.
they froze. Or hoped, or didn't want to accept the loss. They held on. By the time they finally couldn't take the pain anymore and capitulated, that loss wasn't $15 per share. It was $180 per share.
Oh my God. $180 loss instead of $15.
That single failure to honor the original relatively small stop loss cost them more money than potentially 12 winning trades at 1.1 would have made back. It highlights that stops aren't about being wrong or failing.
They're about acknowledging your initial thesis was wrong right now.
Exactly. And preserving your precious capital so you can fight another day? Find the next good setup. Survival first.
So where technically should we place these stops? You can't just pick a random number like all risk 10%, right? They need to be objective.
Absolutely not arbitrary. Stops must be placed at a logical point that signifies the technical invalidation of your reason for entering the trade in the first place.
So if you buy based on support,
Your stop goes slightly below that support level. If the price breaks decisively below that level, the support has failed, your trade thesis is busted, and you need to get out, period. If you're shorting based on resistance, the stop goes just above resistance.
why not place it exactly at the support or resistance level?
Because of market noise and false breaks, you need to give it a little bit of wiggle room, allow for minor tests of the level that don't actually break it. Arbitrary stops, like a fixed percentage, often get hit by this random noise, forcing you out of perfectly good trades unnecessarily.
Okay, and you mentioned earlier adjusting stops based on volatility using ATR. Let's cover that. Average true range.
Right. ATR is crucial. It measures the typical price range or volatility of a stock over a recent period, usually 14 days. Why does it matter for stops? Because a $5 stop might be perfectly reasonable on a slow-moving utility stock, but on a highly volatile stock like, say, Tesla or Nvidia, a $5 stop is way too tight.
It'll get hit constantly just by normal daily fluctuation.
Exactly. So Bolt recommends using a multiple of the ATR to set your stop distance. A common approach is placing your stop 1.5 times or 2 times the current ATR value below your entry price for a long trade.
So if the ATR is, say, $3,
You might place your stop $1.53 equals $4.50 below your entry, or $3 and $6 below your entry. This ensures your stop respects the stock's current volatility, making it less likely to be triggered by noise, while still being technically logical and fitting within your 1-2% overall risk calculation.
that makes sense. A volatility-adjusted stop. What about those nightmare scenarios, though? Like a huge overnight gap down on bad news or a flash crash where your electronic stop doesn't get filled where you want it.
Yeah, black swan events or system failures. Bolt advises having what he calls a catastrophic stop or a disaster stop. This is like your final circuit breaker.
How does that work?
It's usually a wider predetermined percentage loss level for any single position, maybe 5% or even 10% of the position value, though hopefully your initial 1-2% account risk stop is much tighter. If for any reason, a gap, a system failure, anything a position moves against you by that catastrophic amount in a very short time, you just get out. No questions asked. It's the ultimate protection against unforeseen disasters.
Okay, protect
100%.
against the unknowns.
Right.
Now let's flip to the other side. Taking profits. Setting targets. This sounds like it should be the easy part, but Bolt says grade often gets in the way.
It's surprisingly difficult for many traders. The desire to squeeze every last penny out of a winner can be just as destructive as the fear of taking a loss. He shares his own $40,000 lesson in greed from a Nvidia trade in 2021.
Another Nvidia story. What happened there?
He had a well-defined profit target at $250 based on objective resistance levels identified beforehand. The stock hit $250 beautifully.
Plan executed. Time to sell.
Oh, have been. But the stock had strong momentum. It pushed a bit higher towards $280, and Bolt got greedy. He abandoned his plan, thinking maybe it'll hit $300.
Chasing the dream.
Chasing the dream. He ignored the objective technical signal and the contract he'd made with himself. And of course, the stock quickly reversed, collapsed back down, and he ended up scrambling to sell around $235.
So he sold below his original target.
Way below. He watched thousands in potential profit evaporate simply because he let greed override his predefined system. He failed to honor the target.
So profit-taking needs to be just as objective and planned as stop placement.
Just as objective, no guesswork, no emotion. Where should targets logically be set?
Where does Bolt suggest?
Well, the most straightforward method is at clear, pre-identified resistance levels on the chart. Just like stops go below support, targets often go just below resistance.
Okay. Any other methods?
Measured moves are another common technique. We touched on this with the Netflix breakout projecting the height of a prior consolidation range upwards to get a target. You can also project the length of previous swing highs. And finally, consider psychological levels.
Like round numbers.
Exactly. Big round numbers like $100, $200, $500 often act as psychological resistance because many orders cluster there. So if your technical target is near, say, $200, Bolt suggests maybe setting your actual take profit order slightly below it, like $198 or $199, to increase the odds of getting filled before the wall of sellers at the round number kicks in.
Front-running the crowd a little bit.
Just a bit, tactically. Now, the ultimate discipline, Bolt says, the key to maximizing winners and never letting a good trade turn into a loser, is using a trailing or ratcheting stop strategy.
Okay, how does that work? Locking in profits as the trade moves in your favor.
Precisely. It's about making sure a winner can't turn into a loss. Rule number 1 is crucial. Once a trade has moved in your favor by about 1.5 times to 2 times your initial risk amount,
So if you risked $100, once you're up $150 or $200.
you immediately move your original stop-loss order up to your break-even entry price.
Ah, the no-lose trade.
Exactly. At this point, the worst that can happen is you get stopped out for zero gain or loss, minus commissions. You've taken the risk completely off the table. That's a huge psychological win.
Okay, that's rule 1. What's rule 2 for letting profits run further?
Rule 2 comes into play once the trade hits your initial target or maybe achieves, say, 3 times your initial risk, hitting that ideal 1 to 3 RRR.
Okay.
At that point, you move your stop loss again, but this time you move it up to lock in at least 1 unit of your initial risk as profit.
So using the $100 risk example, if the trade is now up $300,
You'd move your stop loss up to a price level that guarantees you exit with at least a $100 profit, even if the stock suddenly reverses hard against you. You're guaranteeing a minimum win, securing some profit, while still allowing the potential for the trade to run even further if the trend continues.
that sounds like a really disciplined way to manage winning trades. Take risks off, then lock in profit, then let it run.
It's mechanical. It removes the emotional decision-making in the heat of the moment and turns volatility into an advantage rather than a threat. Hashtag tagged Hogex sign, building the system and psychological mastery.
Okay, so when you put all these pieces together, the disciplined RRR focus, the strict 1-2% position sizing, the objective stops and targets, the ratcheting stops, you really start to see the shift, don't you? You move from reacting and gambling to operating a system.
That's the goal. It becomes a repeatable, scalable business model. And that, Bolt argues, is the fundamental difference between a professional trader and a gambler.
How does he define that difference?
It's simple. A trader follows a predefined written system. That system clearly outlines the exact criteria for a valid setup, the specific entry rules, the stop-loss placement, the profit target logic, and the risk allocation position size before any trade is ever placed.
All planned out.
All planned. A gambler, on the other hand, makes individual bets based on gut feelings, tips, news headlines, hope. There's no consistent process.
And to ensure you're actually following your system, you need accountability. Which brings us to the trading journal.
Absolutely essential. And Bolt emphasizes tracking performance not just by the bottom line, the profit and loss, but by the quality of your execution.
What does he mean by that? A trades versus F trades.
Exactly. An A trade is any trade, win or lose, where you followed your system perfectly. You identified a valid setup according to your rules, you entered correctly, you used the right position size, you placed your stop correctly, and you managed the trade according to plan, honoring the stop or target or using a trailing stop.
Even if it lost money, it was an A trade because you executed flawlessly.
Correct. That's a win for your discipline. An F trade, conversely, is any trade where you broke your rules. Maybe you chased an entry, used too much size, violated the 1-2% rule, failed to place a stop, moved your stop further away when the trade went against you, or took profits way too early out of fear.
And here's the scary part. A winning F trade is actually terrible for you long term.
It's incredibly dangerous because it reinforces bad habits. You got lucky, you broke the rules, and it worked out this time. That makes you more likely to break the rules again, and eventually that undisciplined approach will lead to disaster. Professionals focus on executing A trades consistently. The P&L takes care of itself over time if the system has a positive expectancy, which a good RRR ensures.
The journal keeps you honest about your execution. But even with a great system and a journal, our own minds can still sabotage us. Bolt talks about the psychological traps.
They're always the weakest link. He outlines several common cognitive biases that constantly threaten to derail even the best RRR-based systems.
We already touched on loss aversion. That powerful desire to avoid booking a loss, which makes people hold losers too long.
Right. That emotional pain directly attacks your stop-loss discipline, inflates your average loss size, and destroys the positive mathematical asymmetry you're trying to build with RRR.
What's another big one?
The flip side, early exit temptation. This is cutting your winners short. You have a great 1 to 3 setup, the trade is working, maybe it's up 1.5R or 2R, but you get nervous. You fear the profit will evaporate.
So you snatch the profit early.
You snapped it early, maybe locking in just 1.5R instead of letting it run towards the planned 3R target. You prioritize the short-term psychological comfort of booking a win over the long-term mathematical necessity of letting your winners be significantly larger than your losers. Doing this consistently cripples the RRR edge of your system.
You need those big winners to pay for all the small losers.
You absolutely do. And the third big one is recency bias.
How does that play out?
It works both ways. If you just had a big winning trade, recency bias can lead to overconfidence. You feel invincible. You might take the next trade with way too much size, thinking you can't lose, violating the 1-2% rule.
Setting yourself up for a big fall.
Exactly. Conversely, if you just had a string of frustrating losses, recency bias can lead to fear and hesitation. You see the next perfect A-trade setup according to your rules, high RRR, everything looks great, but you're too scared to pull the trigger because you remember the recent pain. You miss the winner that could have turned things around.
So your recent emotional state overrides your objective trading rules.
Constantly. These biases are deeply ingrained. The only real antidote, Bull argues, is a fundamental mindset shift, the shift that defines professional trading.
What is that core shift?
It's accepting, truly accepting deep down, both intellectually and emotionally, that your goal is not to be right all the time. It's not about predicting the future. Bolt himself points out his own long-term success comes with a win rate that's actually slightly below 50%, around 48.7%. He's technically wrong more often than he's right.
That's mind-blowing for most people to hear.
It is. But his edge doesn't come from prediction. It comes from structure and discipline. The focus has to shift entirely away from being right and onto flawless execution of your system. And crucially, it requires mastering the art of losing properly.
Losing properly, what does that mean?
It means taking those small, inevitable losses quickly, unemotionally, according to your predefined plan, your stop loss, treating them as a normal expected cost of doing business, like rent or electricity for a regular company. If you can master losing, keeping losses small and controlled,
Then the winning takes care of itself.
exactly. Because your system, built around a positive RRR, like 1 to 3, ensures that your winners, when they come, will be significantly larger than your small controlled losses. The mathematics of the ratio will then work its magic through compounding over time. Focus on the process, execute flawlessly, lose properly, and the results will follow. #tag7.
Right, that feels like a comprehensive deep dive. We've really unpacked the power of the risk-to-reward ratio, haven't we? Stressing how it's the primary driver of long-term profit, much more so than just trying to be right all the time.
Definitely. We covered why that ratio matters, the math behind it, why 1 to 2 is the bare minimum and 1 to 3 is the goal.
We talked about finding those setups using support and resistance, breakouts, pullbacks, even things like moving averages and Fibonacci levels to define objective risk and reward points.
And critically, we covered position sizing, that non-negotiable 1 to 2% rule as the backbone of survival, protecting both your financial and mental capital.
Plus the discipline needed for execution, honoring those stops, setting logical targets, and using techniques like the ratcheting stop to manage winners effectively.
What really stands out from Bolt's work, I think, is how this RR framework gives you something objective, something mechanical. It takes the constant guessing and emotional turmoil out of trading.
It turns it into a process.
It turns it into a process, a business operation. You're no longer just reacting to blinking lights on a screen. You're managing probabilities and expected value based on a system that has a mathematical edge. That systematic approach is truly what separates the pros from the amateurs.
Okay, so let's leave our listeners with that final provocative thought, building on Ryan Bolt's core message. What's the ultimate truth here?
I think the ultimate truth, the thing that really separates those who make it from those who don't, is this. You don't actually need to win consistently to make money in trading.
You need to lose properly.
You need to master the art of losing properly. If you can consistently take small, manageable losses according to a strict plan, without emotion, without deviation, then winning literally takes care of itself. The positive asymmetry of your RR will compound your capital over time. Focus on losing correctly, and success becomes almost inevitable.
Master your losses, and the profits will follow. Powerful stuff.
Trust the process, respect the ratio, protect your capital. That's the game.
If you want more videos like this, subscribe to this channel right now. Thank you.